Hello there. This video marks the beginning of a sequence of videos on problem sets and financial accounting. In these problem sets, we'll be solving exercises which you can encounter in a typical financial accounting exam. I'll be creating a separate set of videos explaining the theory behind these concepts in financial accounting, and depending on when you watch this video, that might be already available, and you can find that in the description of this video. Now we'll get started with this first problem set, which shows an exercise on how to prepare journal entries and create financial statements from these journal entries. Here we have a set of transactions for the month of April for a company, okay, and we're going to prepare the journal entry for these transactions. We can start making the journal entries below here for each of those transactions, okay. So we'll be showing the debit side in this column and the credit side in the next column. These transactions are made during the month of April, for which we're going to prepare the journal entries, and we'll be preparing the financial statements at the end of April. Okay, so let's begin with transaction A. The firm issued 500 shares of stock, 1,000 shares in total, to each of the two investors in exchange for $6,000 of cash. Okay, so the cash account is going to be debited, okay, because cash is an asset which goes up or which increases, okay, and hence it's being debited by $6,000. Okay, on the other side, okay, contributed capital, which is the original stockholders' equity, is the account which is going to be credited. Okay, because it's a stockholders' equity account, as it goes up, it's being credited. Okay, now for transaction B, the firm acquired tools or equipment with the list price of $675 for $500. Okay, although the list price is $675, the firm ends up paying only $500. The firm pays the supplier $200 in cash and also signed a 3-month note for the balance. For the remaining $300, it also signs a 3-month note. The journal entry for this is, first you're receiving an equipment of value $500. Okay, so that's an asset which increases, and hence I'm going to debit my equipment by $500. Okay, because I'm paying cash of $200, my cash account is being credited by $200, because cash is an asset which decreases, right, or which goes down, and hence I'm going to credit it. Okay, I'm also signing a 3-month note, okay, promising to pay my supplier that I will pay my $300 later. Okay, so that becomes a notes payable, which is a liability, and hence it's being credited. Okay, moving on to transaction C. The firm purchased 4 acres of land for the future site of a data facility and paid cash of $10,000. Okay, land is a fixed asset which is being debited. Okay, so that's 10,000 of debit. Okay, and the firm pays cash. Okay, so cash is being credited 10,000. Okay, for the purchase of the land. Both land and cash are assets. Okay, one account is being debited and the other being credited, and hence you can see that the accounting equation or the balance sheet equation stays in balance. Moving on to the next transaction, transaction D. The firm ordered and received equipment from Everything Incorporation for $5,000, signing a note to pay them in full in 30 days. Okay, so the firm receives equipment worth $5,000, for which they will be signing a note to pay them later. Okay, so equipment is an asset, and hence I'm going to debit it by $5,000. Okay, I'm not paying cash yet. I'm signing a notes payable, okay, promising to pay them later for $5,000. Okay, notes payable is a liability, and hence it's credited. Okay, moving on to transaction E. The firm sold for $2,500 1 acre of land to the city for a park, and it accepted a note from the city for payment by the end of the month. Okay, so it's selling one of those 4 acres which it purchased for $2,500, and the city would provide a note promising to pay later. Okay, so there is a notes receivable, okay, from the city that they will pay you later. Okay, and notes receivable is an asset, and hence it's debited. Okay, and our land account has to be credited by $2,500 because now we've sold one of the 4 acres we bought. Okay, the next transaction F, purchased and used gasoline for cars, paying $75 in cash at a local gas station. So this $75 is an expense, okay, expense for fuel, right? So fuel expense is an account which is going to be debited because expenses are debited. Expense accounts are debited because the more you spend, the lesser your stockholders' equity becomes. Okay, and what becomes the credit account here? You're paying by cash, and hence your cash goes down, or your cash account is credited by $75. Okay, next is transaction G, received from the city $1,200 cash in advance for services for April through July, $300 each month. Okay, so the city pays in advance $1,200 in cash for which you'll be providing services for the next 4 months. The entire amount was recorded as unearned revenue. Okay, this is unearned revenue because you've not provided the services to the city yet. Okay, unearned revenue is a liability. Okay, but you received cash already for that, so cash is going to be debited by 1,200. Okay, unearned revenue is a liability because you haven't provided the services yet. Okay, transaction H, purchased $600 of insurance covering 6 months, April through September. The entire payment was recorded as prepaid expenses. Okay, you're purchasing $600 of insurance for the next 6 months. Because you're paying in advance and the insurance company would provide you these services in the future, prepaid expenses are considered as assets. Okay, cash goes down, and hence the cash account is being credited by $600. Okay, the next transaction I, we served something company who are billed every month. A total of $10,800 of service was billed in April. Okay, so we provided our services to another company for which we earn a revenue of $10,800 in April. Okay, it doesn't say anything about the payment yet, but we've billed them for this amount. So we have an accounts receivable of $10,800 because we provided these services to this firm for which they will pay us later. Okay, because we've already provided them the services this month, it becomes our revenue. Okay, we've earned this revenue because we've provided them these services. Okay, transaction J. Okay, this is related to the previous transaction. Okay, our client, something company, they've paid us $9,500 on their accounts. Okay, they haven't paid the whole amount yet, but they are paying a part of it. Okay, for which we are going to record this journal entry now. Okay, so they are paying $9,500. Okay, so we collect cash of $9,500, which is getting debited. And from our accounts receivable, we need to remove $9,500. Okay, because the receivable is no longer $10,800. We need to reduce it by $9,500, and hence we credit that account. Okay, the next transaction K, the firm paid wages every month. Total cash paid in April was $4,900. Okay, so the firm has paid wages of $4,900 for the month of April. Okay, wages are an expense and hence they are debited. Okay, and cash goes down, so that's gonna be credited by $4,900. Okay, the next transaction L, the firm received a bill for $420 from the local gas station for additional gasoline purchased on account and used in April. Okay, we've received a bill for additional gasoline which we purchased on account, okay, and we've used it in April. Okay, so this becomes a fuel expense because we've used it, right? We purchased and used it in the month of April, so it becomes an expense. We haven't paid cash yet, okay, so it becomes an accounts payable of $420. Okay, the next transaction M, the firm paid $600 principal and $40 interest on the note it owed to Everything Incorporation. Okay, this is related to transaction D, okay, where we've ordered some equipment from Everything Incorporation, for which it looks like we're not paying the entire amount, although we owe them in 30 days, okay, but we are paying $600 of the original amount plus $40 of interest so far to Everything Incorporation. Here's how we note that down. Okay, from the notes payable, okay, we are going to remove 600. Okay, notes payable is a liability and hence it's credited typically, but here because we are returning the money, okay, I'm debiting the notes payable account. Okay, there's also an interest expense of $40 because it's an expense, I'm debiting it, and my cash goes down by $640 and hence I'm crediting that account. We can always see that in each of these transactions that the total debits is equal to the total credits. Okay, moving on to transaction N, the firm paid $100 on accounts payable. Okay, so you're paying $100 on the accounts payable you owed. Okay, accounts payable is a liability, and because we are paying $100, it's being removed from that account and hence I'm debiting it. Okay, my cash goes down, so $100 is being credited. Okay, next, the final transaction O, the firm collected $1,000 principal and $15 interest on the note owed by the city to Nothing Company. Okay, so whatever the city owed us, for which transaction E, right? We sold them a piece of land for $2,500 for which we accepted a note from the city. Okay, so we are collecting $1,000 from out of that with a $15 interest. Okay, how do we take note of that? Our cash goes up by $1,015, right? Okay, and from our notes receivable, we are going to reduce our notes receivable by $1,000. Okay, notes receivable is an asset, so when I credit it, I'm removing the $1,000 from that particular account. Okay, then I also have some interest revenue, okay, which is $15. Okay, so we've completed all the journal entries so far based on these transactions. So now before we create the financial statements, the next step is to tally all these journal entries and calculate the balances of each of these accounts. Okay, for that I'm going to use a separate sheet. I'm going to classify all my accounts which we've created in the previous sheet under assets, liabilities and stockholders equity. Okay, so that it's convenient for me to create my financial statements later. Okay, so under these three categories, okay, we're going to see which of the accounts we are using. Cash is an asset, contributed capital goes under stockholders equity. So we're going to start with cash, and contributed capital goes under stockholders equity. Okay, and for transaction A, cash increases by 6,000. Okay, so that's 6,000, and contributed capital of 6,000. Okay, I'm going to create a check here. Okay, the check will show us if the accounting equation always stays in balance for each of these transactions, just to make sure we don't make a error. Okay, so I'm basically going to sum all my potential assets. Okay, and I'm going to subtract that the sum of my liabilities and stockholders equity. Okay, so this check has to always stay in 0. Okay, then transaction B, equipment of 500, cash goes down 200, and notes payable of 300. Okay, so we're going to create a new account here, equipment of 500. Okay, cash goes down 200. Okay, so instead of saying I'm going to credit cash 200, I put a negative 200 here because I'm going to use this to calculate the total balance. Okay, the third account was a notes payable of 300. So that's a liability. Okay, notes payable of 300. 300 there. Okay, then transaction C, land is an asset going up by 10,000 and cash is an asset which is credited by 10,000. Okay, so I create a land column here which goes up by 10,000, but my cash goes down by 10,000. Okay, let me just so we have transactions until O, I presume. And we're gonna find the total balance at the end. Okay, I'm going to make this sheet a bit more readable. Okay, I'm going to make the assets a particular color, let's say green, and liabilities, I'm going to put them under a particular color, and shareholders equity under a different color, so it's easy to read as I proceed with the further transactions. Okay, and yeah, okay, there we go. Transaction D, your equipment increases by 5,000 and you have a notes payable of 5,000. Okay, equipment increases by 5,000 and a notes payable of 5,000. Okay, let me click and drag the formula for my check. Okay, you can see that it still stays at 0 until transaction D. Okay, now for transaction E, notes receivable increases by 2,500 and land goes down by 2,500. Okay, notes receivable is an asset. So that is 2,500 and land goes down by 2,500, hence the negative sign. Okay, the next transaction, fuel expense of 75 and cash goes down 75. Cash goes down 75 and fuel expense goes under stockholders equity, but because it's an expense, it has a negative effect on the stockholders equity, so I'm going to record it using a negative sign. Okay, so fuel expense is $75, which decreases the stockholders equity by $75. That's how I would read the negative sign here. Okay, transaction G, cash goes up 1,200 and unearned revenue of 1,200. Okay, cash goes up 1,200. Unearned revenue is a liability, which is also 1,200. Okay, transaction H, prepaid expenses of 600 and cash goes down 600. So prepaid expenses is an asset. Okay, so that would be 600 and cash goes down 600. the next transaction, accounts receivable increases by 10,800 and you have a revenue of 10,800. Accounts receivable is an asset, so we're going to create that. Accounts receivable of 10,800. Okay, and we have revenue of 10,800. 10,800. Okay. The next transaction, transaction J, is you collect cash of 9,500 and your accounts receivable goes down by the same amount. Okay, so you get cash of 9,500 and your accounts receivable goes down by 9,500. Okay, transaction K, wage expense 4,900, cash goes down 4,900. So cash goes down 4,900. Okay, and now I'm going to create a separate column for wage expense. Because it's an expense, I'm going to mark it with a negative sign, because when you have expenses, it decreases your stockholders' equity. Okay. L, fuel expense of 420 and accounts payable of 420. Okay, so you have an accounts payable, which is a liability, of 420 and you have a fuel expense of 420. Again, I use the negative sign. Okay. Next to transaction M, notes payable goes down by 600 or is debited 600. You have an interest expense of 40 and cash goes down 640 or cash is credited 640. Okay, so let's start with cash here. Cash is credited 640. Okay, it goes down by 640. Your notes payable, what's it? Your notes payable goes down by 600. Okay, so that's being debited 600. And you have an interest expense. I'm going to create a new column for that. Okay, because it's an expense, it's going to come with a negative sign for negative 40. Okay, the next transaction, transaction N, accounts payable $100 and cash $100. So your accounts payable is being debited $100. Okay, so I'm going to remove $100 from my accounts payable. Okay, and I will remove the same from my cash. Okay, the last transaction, which is transaction O, you collect cash of 2015, notes receivable of 1,000 is being reduced. Okay, and interest revenue is $15. Okay, so from my notes receivable, I'm going to remove $1,000. Okay, and I collect cash of 1,015. Okay, and I have an interest revenue. Okay, of, because it's revenue. Okay, so comes with a positive sign. Okay, plus 15. Okay, now in the last row here, I'm going to calculate the balance of all these accounts. Okay, so I'm just going to add up all the rows until transaction O. Okay, now I'm going to extend that to all these accounts. Just copying the formula to all these columns. Okay, once we've tallied all these accounts under assets, liabilities and shareholders equity, and we've calculated the balances for these accounts, it's time for us to create the financial statements. Okay, we'll start with the income statement or the profit and loss statement. Okay, so we can calculate the profit before we create the balance sheet and cash flow statements. Okay, the income statement has the typical structure of an income statement is you have your total revenues, you subtract all your expenses in order to calculate your profit. Okay, the revenue you've generated is 10,800. Okay, so we start with revenue, and the revenue I'm just gonna link to these cells instead of manually typing the numbers. Okay, What are the expenses I have? I have fuel expenses, wage expenses, and interest expenses. Okay, so fuel and wage are operating expenses, right? Okay, so I'm gonna say fuel expenses and wage expenses. Okay, so the fuel expense would be 495. Wage expenses is 4,900. Okay, then we can have kind of operating profit before we subtract or add our interest revenue and interest expenses. Okay, so this would be, I just have to add these numbers now because my expenses are already marked with a negative sign. Okay, then I have my interest revenue or my interest income. Okay, and then I also have my interest expense. Okay, the revenue I've generated from interest is $15 and the expenses I've paid is this $40. Okay, so now my final profit, okay, let's call it the pre-tax profit, is the sum of the operating profit we calculated plus after including and eliminating the interest expense. Okay, I'm going to drag that column a bit here. Okay, so that's my income statement. Okay, because in this exercise I've not provided you any tax information. Okay, you can consider the total tax is 0. Okay, and that becomes your net income. Okay, the net income is the after tax profit, so it's that minus your taxation. Okay, so that's your net income. The next statement we're going to create is the statement of retained earnings. Okay, if you had retained earnings from a previous period, okay, you would start with that balance. Okay, so let's say beginning retained earnings. In our case, because it's a new firm which was started in April, that's going to be 0. Okay, to that we are going to add our net income. Okay, so we have it there. Okay, and we need to subtract the dividends paid in order to calculate the new retained earnings, right? In this case it's 0 because we've not paid any dividends in this period. Okay, and now the ending retained earnings is basically the beginning balance plus the net income minus the dividends paid. Okay, in this case it's exactly the same as the net income because we didn't have any other information. Okay, the next statement we create is the balance sheet. Now our task becomes a little bit easier, okay, because we've already arranged that in the order of assets, liabilities, and shareholders' equity in the tally we created above. Okay, so we're going to start with assets. Okay, all our assets are cash, equipment, land, notes receivable. Okay, so we're going to take down our assets there. Okay, so we have our cash, equipment, land, notes receivable, prepaid expenses, and accounts receivable. Okay, I'm just gonna link those cells now. Okay, our cash is that much, equipment is that much, land is 7,500, notes receivable is 1,500, prepaid expenses that, accounts receivable is 1,300. Okay, so our total assets are basically the sum of all these. Okay, I haven't classified them as current and non-current assets as of yet. Okay, but we'll see those in later problem sets. Okay, then our liabilities. Okay, we're going to start with notes payable, unearned revenue, and I'm going to try to copy these accounts. Okay, there we go. So our notes payable is 4,700. Unearned revenue is 1,200. Accounts payable is 320. Okay, so total liabilities is the sum of these three accounts. Okay, then we have, for shareholders equity, we have contributed capital, and we can use our retained earnings we've calculated. Instead of showing all our revenues and expenses separately, we can just show our retained earnings. Okay, so contributed capital is 6,000. Retained earnings we've calculated here is 5,380. Okay, so now the total liabilities and stockholders equity together, okay, is equal to, we take the total liabilities and we add it with the contributed capital and the retained earnings. Okay, we can see that because we've had a check at every step, we can see that the total assets is equal to the total liabilities plus stockholders equity. Okay, the last statement we have to create now is statement of cash flows. Okay, so the cash flows have to be classified into operating cash flows, investing cash flows, and financing cash flows. Okay, cash flows from operations, cash flow from investments, and cash flow from financing activities. Okay, so now we go back to our journal entries to see which of the cash flows follow under each of these segments. Okay, let's start with wherever we have a cash transaction, and we'll try to identify what category they belong to. I'm going to use the alphabets O, I, and F to refer to operating activities, investing activities, and financing activities for cash flows. Okay, for transaction A, contributed capital, because the cash was provided by our investors, it's a cash flow from financing activity. Okay, when we buy equipment, that's a cash outflow for an operating activity. Okay, land, again we pay, it's an operating activity. For fuel, again it's an operating activity. Cash which we collected in advance for operations, again we paid for insurance in advance here, again it's cash from operations. Okay, cash collected because of revenue from our customers, again it's operations. Cash for wage expense, again it's operations. Cash for paying what we owed, again it's operations. Okay, cash for accounts payable, it's also operations. Okay, cash we collected from the city, again it's part of the operations. Okay, so we can see most of these are operations related, except for the first contributed capital, which is cash flow from financing activity. Okay, so in our case, cash flow from operations, that's going to require a bit more of space there. Okay, so I'm going to put down all the cash flows from my operations, which are these cash flows. Okay, except the 6,000, which is from financing activities. Okay, so here I'm going to put them down as okay, this shows all the cash flows from operating activities. Okay, and then we can kind of show the total here. Okay, total from operating activities. Okay, you'll have to specify on the left where each of these cash flows are from. Okay, so that's cash flow from operations. Cash flow from investments, we didn't have anything. Okay, cash flow from financing activities, we had some contributed capital from our investors. Okay, so that would be just the 6,000. Okay, and then we'll also have beginning cash balance. So we do the same as we did for retained earnings, right? So we have a beginning cash balance. In this case, because it's a new firm, it's 0. Okay, and then we have total cash flows for this particular year. Okay, where you're basically going to add the totals of the 3 categories of cash flows. Okay, in this case just 2. And then you have your ending cash balance. Okay, which is the beginning plus the total cash change for the year. Okay, so that's what the typical cash flow statement looks like. Okay, that's how you create the 4 financial statements in that particular order. You start with creating the income statement to calculate the net income. Okay, and then you move to the statement of retained earnings to see how much of that net income is being retained. Okay, and then you can create your balance sheet to show your assets and liabilities and stockholders' equity. And finally, we create our statement of cash flows in 3 different categories: cash flow from operations, cash flow from investment activities, and cash flow from financing activities. Okay, and finally, we can show the ending cash balance. You can see that this cash balance, okay, matches the cash flow we calculated here. This concludes our first problem set. In the next problem set, we'll look at some exercises which deal with adjustments at the end of the period. Thank you for watching. Cheers.